About expectations around a pivot is the desire for instant gratification on that front, especially if by pivot you mean going from aggressive rate hikes to rate cuts. That was the narrative in mid-June. That made no sense to us because simply inflation peaking and starting to come down was not going to be the green light for the Fed to not just stop raising rates but cut rates. So I think there are a lot of steps in this process from where we are now to what would be defined as a pivot. And probably the first step is a series of data points that supports the idea that they can not pivot to rate cuts, but actually maybe telegraph a less aggressive stance, telegraphing 50 or 25 instead of 75. And then you would get the actual move by the Fed with maybe a milder hike akin to what the RBA just did. Then get to the point where they're in pause mode. Then see what happens with inflation, the recession, and then at some point they consider rate cuts. But there's a lot of steps between now and a pivot to rate cuts, and I think we have to get out of the mode of wanting that instant gratification, that one number is going to be that signal.
Right. So therefore, next week's CPI report, of course, that would be one of those numbers that we might anticipate in that direction, but may not be sufficient?
Well, not sufficient, especially given that not just Powell, but others on the Fed have said, they've used slightly different language, but a series of lower lows, months worth of lower lows, something that gets closer to their target. And I think now, us included, a lot of folks have been doing the calculations because of how the math works with base effects, what month-over-month average change would look like, and when that brings inflation, at least in the case of CPI, down to below a 3 handle. And all of those trajectories are into 2023. So, yes, if we saw both headline and core show a decline, that's a step along the way. But 1 month or an additional month beyond what we got with the peak and headline is not going to be enough, I think, to make the Fed see a green light.
I know you've made the point in the past that historically when the Fed feels forced to actually ease after it's been tightening, that often is not because things are good and the market doesn't respond necessarily very well immediately on that. It's almost as if we should hope for moderation in what the Fed's doing and not some kind of, financial or economic problem that forces them to cut soon. Right.
Aside from an easing in inflation, plus maybe a bit more weakness in the labor market, which we didn't see today, a near-term green light for the Fed to have to step in and consider rate cuts, to your point, Mike, would likely be serious financial system instability or something actually breaking. And I'm not sure that's what you want to wish for at this point. Even if it's a bit more of an elongated process, I think a process of inflation coming down, some tightness in the labor market coming out of the stats, even if it means a move to pause mode is a little bit later, not sooner, I think that's a better environment for the market than a crisis situation that causes the Fed to have to do a 180 in short order.
Yeah, exactly. A good example of be careful what you wish for. Lizanne, thank you very much. Appreciate you calling in.
My pleasure. Have a good weekend.
All right.